All right, folks, welcome back. This is our Monday commentary for January 10th, 2022. I'll try to go through this as speedily as possible. All right, so we have the dollar index daily chart. And again, still stuck in this range. Don't want to beat it to death. I've already done so for over a month and a half now. We'll be looking for more of the same, but I'm still favoring the upside. I don't want to, again, try to predict a long-term reversal on the dollar index. We had a reaction off of the fair value gap in here I mentioned last week. It gapped in here on the open of the new week, traded down into the gap, had a buy side and balance, sell side and efficiency, retraced back down into that, and then reclaimed all of this range here back to non-farm payroll Friday. So we had a rejection block in here. It traded through that and retraced off of that. And I want to see if it can maintain this low. I'd prefer it not to trade back down below that. I'd like to see this gap remain in place and then see if we can start to make a move for the buy side liquidity up in here. All right, 15-minute time frame on a dollar index. You can see how we traded back down into a volume imbalance here. Traded right into the premium high of that volume imbalance. Drops down into that for London. Creates the low of the day. Rallies, buy side imbalance, sell side inefficiency on a 15-minute time frame. Completely rebalances that here for New York session. Then runs to the rejection block shown here on the 15-minute time frame. Trades back down in. And again, I want to see it work towards these levels here that is building a narrative that this is potentially retail resistance. So I like that idea, and we'll see if it can climb back above that and work towards those levels I mentioned on the hourly and daily. All right, Eurodollar daily chart. Again, just stuck in the mud. Very, very frustrating for anyone that wants to see movement. Euro is really creating a lot of tension in here, and that's nice in a lot of ways because the longer it does this, when it does move, it'll be a little bit more animated than if it were to just do something like this, where it's been a small little range and then it moved. This is a longer term consolidation in relationship to what we've seen here versus this. So we're into what looks like might be 2 months of consolidation. So when we do leave it, again, I prefer the lower level, but it doesn't make a difference to me because whenever it does leave this consolidation, it should bring with it new sentiment or disrupt present sentiment and get hopefully the large funds involved in type of a trending model. Maybe they'll let them have a trend for a little while. Maybe they'll fake them out and then cause them to change their opinion about it and then send it another direction. Either way, we're just waiting for that displacement. The displacement is needed, otherwise you see this. And it's very, very difficult to work within that type of range if you're a new student. All right, Eurodollar hourly chart. Again, we return back into this old imbalance. And this was, again, on the 2-hour chart. So don't let this confuse you. One day last week, I used the 2-hour chart to show the dealing range high and low still. So that's what these levels are. So if you show it on your chart for 2 hours, not 1 hour, this will be a one single candle SIBI. Okay. So we return back into that. Notice the bodies of the candles respecting consequent encroachment. And then fell out of bed. Sell side imbalance, buy side inefficiency. Consequent encroachment here. That might not actually be consequent encroachment. It might be just a little bit short of it, but it's still good enough for government work. Trades up into that. And then another level of distribution. Attacking the rejection block in here. Extend that out in time. You can see it hits that there. And then retrades back into the range that was created from this swing high down to that swing low. Just consolidation. And on the 15-minute time frame for Euro, here's that same imbalance. Sell side imbalance, buy side inefficiency. And then it's further refined inside the 15-minute time frame right here. So the exposed imbalance from this candle's low down to here. So this discount low, premium high is shaded, trades up into that, creates an optimal trade entry here for New York session, and then runs for the rejection block and sell side liquidity here. The rejection block is not being shown here. The rejection block is based on that hourly chart, but the relative equal lows here is the 15-minute time frames discount array. Also, you can see that we have a bearish breaker in here. Now, I want to talk a little bit about how all these wicks or tails, and then we have this gap here. Right, so if we're down here and you see it rallying up, would you expect it to just fill in this here or return back to the breaker? Well, if it didn't have all these wicks below it, I would look for the imbalance just to be filled in and not return back to the breaker. But because we have all these wicks in here, they create like a gap, and it's going to want to draw back into that. So go right back to the body of the breaker there, and it trades right to that there. It overshoots that fair value gap here in the form of a SIBI, but goes to the breaker. Now, again, for clarity, if we didn't have all these tails, all these little wicks below the candles, okay, we call them tails, I wouldn't expect this to be retreated back to. In other words, if this was like the only single tail, I would look for just this to fill, maybe even leave it partially open and then sell off. But because we had all these tails in here, that creates like that gap phenomenon where it can come back in and trade back into that area. And it has multiple reasons to do so, because it was attacking liquidity multiple times and then back to the bearish breaker here, which is this last down close candle. Closing price, the body, extended out in time there. Okay, so if you were looking at this and wondering, you know, how could you know this was going to be overshot and go back to the breaker? It's these tails that are telling that narrative there. Okay, if we didn't have all these tails in here, then it would likely just come into the gap here and not return back to the breaker. Whenever there is a fair value gap just below a bearish breaker, there's a likelihood that it can trade back to the breaker. But if we have tails on all these types of candles, that just makes it muddy, and it's likely to go back to the area of mitigation here. So the algorithm will go right back to that. If it doesn't have all these excessive amounts of candlesticks that are creating wicks and tails, you know, below the lows, or not the lows, but the bodies of the candles, that creates a sloppy area where it needs to go back to a more solid base of order flow, which is inside the candle's bodies. And that's what you're seeing here. So in short, in layman's terms, fair value gaps below breakers, I like to see them just traded to consequent encroachment or partially filled or just filled, and then trade lower if I'm bearish. But if we have a bearish breaker and we have a fair value gap and we have a lot of sloppy price action where there's lots of tails or wicks, then elect to anticipate a return back to the bearish breaker and maybe overshoot the fair value gap here, and then there it is. And then this next candle here works right inside that range again. And if you disregard this here, ignore that wick and focus on this one here, we just open, trade up into institutional order flow entry drill, boom, and then sells off. But you can't technically do that because we have this here, this returning. So at one point when this candle was full on bold-faced bullish candle, you wouldn't be concerning yourself with institutional order flow. You'd be expecting the return back to the breaker, and that would be the end of the story, and then expected to trade lower for sell side liquidity. So just a little discussion on narrative there. All right, pound dollar daily chart. Again, I've been calling this bearish breaker as a draw on liquidity, part of this imbalance here. It's still open. Didn't quite get into it. Almost did it today. I thought we'd get it, but it didn't do it. But in your forex.com data, on the hourly chart here, you can see I have this shaded here. If you pull up like Oanda or other pound dollar data, you don't see this here on the others. Okay, so I'm going to show you this removed on the 15-minute time frame when we drop down, but for now, just kind of like ignore it for the moment. We would turn back to this bearish candle, which is a bullish order block. It rallied up, consolidated, and rallied again. And then we had a little bit of a run above relative equal highs. Didn't quite get to that bearish order block on the daily chart. Fell short of it there, and then broke lower, trading down inside of the rejection block in here. And again, this shaded area, disregard that because we're going to go into a 15-minute time frame. And again, that's that wick right here, or tail, that drops down below here. I don't see this on other data from TradingView like Oanda or others. So if we take that range and cover it up with a white trend line and click on the properties of the trend line and bring it to front, okay, bring to front. If you do that and match up where the low is, I'm using Oanda's low on this candle here. So this is not Oanda's data, it's still Forex.com, but I'm matching this candle with Oanda's data low. So you have this here. So it kind of cleans it up a little bit. Rejection block here, lowest down close here. It trades through it and it's reclaimed again over here. Relative equal highs, it trades above that. Optimal trade entry, sells off. Fair value gap, runs up into that for New York session. Short, trades down to the rejection block that's being reclaimed there, and then back into consolidation. All right, NASDAQ, as I've been mentioning, this is the weaker of all three of the stock indices, and it's proved itself as such today. So on the daily chart here, you can see we have a volume imbalance there, and below that swing low. So we have the imbalance and then volume imbalance. Trades down to the premium high of that level there, and the actual level comes in at 15,155 even. That's what that is here, this opening on that candle. You can check that on your own. The symbol again is N as in Nancy, Q, H for Harry, 2022, and you'll get NASDAQ March 2022 contract. And you can see that information here. And then here is the hourly chart, just reaching down into that level. And I have the 5-minute chart showing the 8:30 to 11 o'clock in the morning New York session. Operating hours for trading 2.5 hours a day and just working inside that range. You notice the higher high formed here. See that? Here's 8:30 and here's 11. So our expectation is this market's bearish. It's leading its group or asset class, which is stock indices, lower. And we see this stop run here. So this little spike up, that's not being met with the same higher high in the Dow, nor is it being met with a higher high in the S&P E-mini contract there. So it's diverging there when it makes a higher high comparably here. So this is a stop run and then breaks lower. Here's your fair value gap. Consequent encroachment, trades up into that, sell short, look for the sell stops, the imbalance, and then if it's going to have an imbalance, look for this levels in here to be drawn to. And the premium high is the first you'd reach for initial target for downside discount. And 15,155 hits it beautifully there, and we get a reaction. The divergence, I want to make sure that you understand when we're looking for the market to show an x-ray view, if you will, of what the market is trying to do. You have to have a bias, you have to have a draw on liquidity. Where's the market likely to be reaching for? It's bearish, it's going lower. What's it reaching for? Well, we have relative equal lows here, short-term low here with sell stops below that. So if it's going lower, you got to have a target or multiple targets where it could potentially draw down into. The SMT divergence between the Dow, S&P, and NASDAQ, we're looking for the weaker. I've already told you what the weaker has been. It's been NASDAQ. And when we see this divergence here, we're focusing on the highs. So we're not going in looking for diverging lows comparably. In other words, I don't care so much about a low that's not being met with the other averages when I'm bearish. That might cause a short-term reversal. It might cause a retracement. I'm more interested in seeing the X-ray view that S&T provides when I'm on side. In other words, if I'm bearish, I'm looking for lower prices. I'm already looking at the weakest of the three averages. Okay, so that's NASDAQ. And if we see a divergence between one average going higher and the other is not doing that, that's that crack in correlation. It's actually showing that smart money's in an aggressive sell program and lower prices should be in order. And then when we get this stop run and we get a displacement like that, you don't need to be smart enough to see that divergence. Some of you may not see it until after it forms, and then you go in and you look for your imbalance, trades up in consequent encroachment or institutional order flow entry drill. Perfect. Why would this be that? Because we have stops below here. So that's institutional order flow entry drill. It should not completely fill in. That is your rules. That's how I taught it to you. And here it is, true to form. Boom, just like that. That's what they like to call cherry-picked hindsight. But it's following the logic and theory that I give you. And here it is in the NASDAQ futures market. Trades down into the discount low. And then we have a nice retracement off of that. Toss this in here, no extra charge. Bitcoin versus the US dollar. This is Bitstamp. Every time I look at Bitcoin, this is the one I look at. It may not be the best one. Please don't correct me. I'm not that interested. So we have these relative equal lows. I mentioned how the market's likely to draw down to the 39,000 sell-side liquidity. And if we build up momentum through that, these over here, relative equal lows, we have 28,000 liquidity as well. If you look at where I mentioned on YouTube, actually showed a screenshot of me in here as this candle created that high, and then we broke down. And then I was explaining how the market is likely to go lower. I mentioned it in the few discussions that we've done on Bitcoin in this mentorship. I said we're looking for lower prices. We had a nice, like a micro flash crash, if you want to call it something like that, traded down here. I thought we were going to go through that, and then we created that big tail. I told you to watch the consequent encroachment level there. We had a little bit of retracement right back up into an old area of order flow where we have a sell side imbalance, buy side inefficiency. The market trades up into that. Notice we have two errant price action wicks here where it goes above it again, and then breaks down. Look at the bodies really giving you the storyline between this candle's low, this candle's high, consequent encroachment, extend that out in time. It's respecting that, which is interesting to me. It's also part of a market maker sell model. Smart money reversal, low risk sell, distribution, second stage, redistribution. And what do you expect? Nice sell off. It's hard to see it here, but if you zoom in, it does go just a little bit below that low. I'll leave it to you to go look at that. I don't personally think it's done going lower. There's a lot of people that just think this thing's going to 100,000. They wanted to see it last year. I said that it's going to have a hard time around 60,000. And 62,000 was about as high as I could see it. And it went obviously above 68,000. But nonetheless, I'm not claiming to be smart in this asset class. When I have an opinion, I share it. And for what it's worth, and believe me, it's not worth anything. The opinion I have is that we're probably going to go back down below 28,000. And how we trade there, okay, is going to be a straight shot to that. I don't think it needs to do that. It would be amazing if it could. It'd be nice to see it happen. I'd like to watch it. But I don't trade this asset class. I've never had an interest in actually trading it. I still don't have an interest in it actually. But how we trade into this low, if it's like aggressive run and like does it in real short order and fashion, then we'll probably have a wicked retracement and go higher. But if we just go lower, back and rebalance, go lower, that's going to be a little bit more sustainable on the downside. And that means we could probably go through this longer term and maybe, and I know some of you probably don't like this, and I could be completely wrong. I've been wrong a few times in this asset class, and that's why I don't like it. But I'm not completely convinced that we're not going back to 20,000. That's to me where I think it's ultimately going to go. And if it goes back below 20,000, that's going to be problematic for a lot of folks. And maybe they might do a crash below that. If I was making the market for this and I had a lot of people trapped long and they keep thinking buy the dip, I'd be taking it back below 20,000. because that'd be a nice short from up in here to get like 46,000, 48,000 points. Yeah, that would hurt real good. All right, so we are looking at the lesson for today. I mentioned last week I would give you 5 examples of visualization of a trade framework. And this one here, I don't want to spend too much time on it because the more time I spend on it, I'm sure it'll create more questions for you, but it's pretty much everything shown here. All right, so let's assume for a moment that you have a market that you've deemed bullish, okay? Now, this could be in the form of a market that has rallied already, and this has just been a retracement, and it came back down to something that was bullish down here. Maybe this is an optimal trade entry, maybe this is an order block that it traded off of, and you're expecting to go higher and come back up into this area right here. It matters not that this high gets taken out. We're looking for this in here to be retraded to, okay? Now, here's the key takeaway. If you remember in the mentorship, I talked about inside days. Now, if you don't know what an inside day is, it's a daily range or daily candle that has a lower high than the previous day's high and a higher low than the previous day's low. So that's why it's called an inside day, because the range is smaller than the previous day. So it's inside of the previous day's range. When it creates these types of days, that tends to be bullish. Now, it could be bullish the very next day immediately, or if it doesn't create a run there, going higher, if you're bullish, then it'll be the following day. So whenever an inside day forms, highest probability is the next day. But if it doesn't move, I give it the very next day. And if it doesn't do then, any rallying, then I leave it alone because it's probably consolidating. So what I just gave you there is a real dandy. So have that in your notes. Now, inside days are not essentially bullish by default. They are just precursors to range expansion. So that's why I'm painting this with the expectation that it is bullish. Every example I show you this week will be buy examples or bullish examples, so that we can reverse everything and the logic would be just the same, just reversed for shorts, okay? So again, this could be a market that has been going higher, created a short-term high, retraced down into some kind of a bullish scenario that now you're anticipating continuation. But now we have something like this. We have an inside day, and we're part of a bullish order flow. We traded back into a order block, this down close candle, and it's an inside day. So you have multiple factors here, and you'd be expecting price to initially run above the previous day's high prior to the inside day. So you're not trading on the inside day. The assumption is once you have this daily candle close, the very next trading day, okay? For instance, let's just say this is Monday. So the next day would be Tuesday. You're trading or looking for what I'm explaining here on Tuesday. If it doesn't form on Tuesday, then we would expect it on Wednesday, okay? It's not limited to form inside days on Monday or Tuesday or Wednesday. Inside days can form any day of the week. But with the logic, the things I teach you with the weekly range and bias and draw and liquidity, I'm trying to give you a framework where these types of scenarios can form in any asset class, and how you can look to see how your tools and concepts blend together to give you a framework for a potential hypothetical trade. All right, so the draw on liquidity is here. So we're looking for that daily fair value gap. Initial draw is the discount low, which would be this candle's high, premium high here, and then consequent encroachment would be midpoint. How we trade above the previous day's high, previous day prior to the inside day, that's first target. So that would be your first scaling. You don't want to take it out above the inside day because it's probably going to be too small of a range. So you're going to use previous day's high prior to the inside day. That will be your first partial. Then, if you wanted, you could use this short-term high if you wanted, but I wouldn't do that because you're already taking it here as a partial. And then you want to see it expand above here and spread, looking for the discount low of the fair value gap here. So if that assumption is understood and we're trying to visualize what a framework would look like on intraday, we're going to assume that this is a 15-minute time frame. And the inside day, high and low, we're going to assume that this is the high of this daily candle. That's the inside day. That's the high of it. And the low, say it forms at the turn of midnight. Okay, So I'm giving you something really, really complicated in terms of not looking for a little reversal here. It's going right down to midnight, and then it turns at midnight. It can happen. It doesn't have to be this format here. It could create a low and then trade a little bit higher prior to midnight, and then create that short-term lower low on the previous day, inside day, and then the next day, which would be like a Tuesday, it could be creating a higher low than the day's low on this candle here. Okay, don't lock this logic into it can only form like this. But I'm just giving you this because this is not as likely to form, but I want to include it to get you thinking that don't be afraid of these types of moves that turn right at midnight. Okay, so that creates the low of the day on both days. This candle here, and then the next candle that forms. But the logic is we're bullish. We're expecting it to expand higher, and we're looking for it to draw up into this area here. That's our higher time frame bias. That's our draw on liquidity. So what we're looking for is during the 2 o'clock to 5 o'clock in the morning, New York time, that's the London Open Kill Zone, we want to see a low form and then start to rally. Once it starts to rally, we wait for New York. So 7 o'clock in the morning to 10 o'clock in the morning, we'll be looking for the kill zone to give us a retracement in the form of a optimal trade entry. Now, ideally, we want to see a fair value gap from this low to the high prior to 7 o'clock in the morning. Then we start to retrace down in post 7 o'clock in the morning, creating a optimal trade entry, preferably a fair value gap in here. That would be a really nice addition to it to add more, I guess, conviction, more trust behind it. The more PD arrays you have behind it, obviously, the better. But you don't need every single one of them to make the trade viable. So we have optimal trade entry here at New York, 7 o'clock to, say, 10 o'clock in the morning. It could simply be the 8:30 in the morning to 11 o'clock window. So if you're trading those 2.5 hours a day, that could be it as well, because the 8:30 news embargo lifts. So that could be the factor that you're basing this on for the time element. Okay, so we have optimal trade entry, preferably with a fair value gap. It doesn't have to have it, but preferably it should have it. So optimal trade entry there. And then what we're doing is we're taking the fib from the low formed in London to the high prior to 7 o'clock in the morning, wherever the highest high would be, and then the retracement down in after 7 a.m. Or if you're using 8:30 in the morning, whatever the high is prior to 8:30, that's where you're drawing your fib on, and then wait for it to drop down into 62%. And then if that occurs and you have a fair value gap, you can look for that with an order block to take a demo trade long and look for it to break above the inside day high, which is here. And you want to see expansion, like you want to see a lot of aggressive expansion and run through previous day's high here. That would be this level here, hypothetically, on a 15-minute time frame. So it's rallying in here to a time target of, again, 10 o'clock in the morning to noon. That's like London close. And we're looking for that time window to match the draw on liquidity on the higher time frame. So we're looking for that high to be broken out, yes, but we're submitting to this logic here that it's going to trade up to that. Okay, so we're submitting to a higher time frame bullish order flow and allowing time to overlap with that. So 10 o'clock to noon and this logic over here. So let's talk about narrative and how this might pan out, what creates these types of events. If we have this type of framework here, this could be seen with a high impact news event that comes out in, let's say, the 10 o'clock hour. Okay, or it's a 10:30 news driver that comes out. Say this is Canadian dollar or crude oil, and the crude oil inventories come out. They usually come out around 10:30 in the morning, New York time. If that happens, we could see that create the catalyst that would draw a price above the inside day high and then the previous day's high. And why I'm showing these levels, because you want to see expansion with a lot of speed, a lot of distance covered quickly, because that would be the signature that, yes, you broke above the inside day. It's a valid run. You took out the previous day's high here. Now it should really run aggressively to get into this imbalance in here. Okay. And first target or partial would be the previous day's high here prior to the inside day, which would be this level here on the lower time frame. You'd have it noted on your lower time frame charts. And then the discount low, the fair value gap on the daily chart here. That would be here, hypothetically. Okay, and this is not the scale. I'm just showing you with the time element, you're waiting for this, for the price, but time-wise, you're not going to look for a reversal. You're not going to be scared that it's reversing because it went above previous day's high. You're not looking at it as like a turtle soup reversal. You're looking for it to go up into this level, which is here. From a time-based perspective, you're looking for 10 o'clock to noon. So you're holding on to as much as noon. But the price element, what's the price you're looking to trade to? The discount low here. So that'll be scaling out at second partial, okay, or second target. Third would be consequent encroachment. Best case scenario would be premium high here. So the trade framework is looking for an optimal trade entry. Now, in this run here, you may not see a fair value gap or a short-term optimal trade entry that lines up with the 62% retracement level. What I would do is, this is the logic on a 15-minute time frame. I would look at a 5-minute chart, scale down to 5 minutes, and you're probably going to see a swing low form between this low and this high prior to the New York kill zone or the New York 8:30 to 11 time window if you're going to use that 2.5 hour window. And I'm providing you flexibility because I don't want to press you into a mold. I want you to think about how it would fit your schedule, your life. Some of you probably can't do 7 o'clock in the morning, but 8:30 is a little bit more appropriate for you. I can't imagine the things that would become catalysts for that to occur, but I'm trying to think outside the box to provide a way for you all to find your own niche in this. But the elements of time, they have to be considered at least in one of those formats. But holding for the expansion up into 10 o'clock to noon, that is kind of like a static. That has to happen. So that way you're allowing the market to expand and the algorithm reaching up into the time elements that it operates on. So if you can get long in here on a 5-minute chart, optimal trade entry, you might see a swing low from this low to the high. It may be inside this part of the run here on a 15-minute time frame, but zooming in on a 5-minute, you'll see another short-term low, which would look like kind of like this, but just beginning with another short-term low here to this high, and then it retraces down into a 62% or 79% retracement level for a 5-minute optimal trade entry. And it might have your 5-minute fair value gap in that time frame, and that would be nice because it would be the pattern you're looking for, the time of day you're looking for it, and you're expecting that expansion on the day after the inside day forms, and then seeing all the targets here. So again, the only thing that's lacking here is the money management. I don't know how much you're going to risk, and again, it's something I would like to see form on a Monday, Tuesday, or Wednesday, but it can form any day, and it could be forming on the basis of a large high impact or medium impact news driver on the economic calendar that would send it careening to this level here on a news report that would probably come out, after 8:30 at least. So 8:30 when that news embargo lifts, between that and say 10:30, okay, some kind of news driver would come out in those 2 hours. That would probably be the catalyst or smokescreen that the central bank uses. And it might be a manual intervention, or it could simply just be the algorithm expanding, using it to have the volatility behind it. But that type of run here would be expected. Once the high's broken here and we get above the previous day's high, it should be really big expansion to get up into that daily fair value gap. So again, this is just one thing, one interpretation of how you can use the concepts. This forms many times in other asset classes, not just in Forex. Inside days are really, really good precursors to big range expansions. And tomorrow, I'll give you another trade framework.